Supermarkets reporting earnings today. Morrison's shares have pared gains after popping 4% in early trade. This despite reporting a 51% decline in first half profit. Morrison's, as you can see, is fractionally down, in fact now down 0.6%. The group said that the drop was largely due to price cuts that were made to offset competition from rivals. Shares in online grocer Ocado also trading higher despite posting a fall in average weekly orders, up 2.9% as we speak. Gross sales, however, increased by 15.5%. Home Retail, the operator of both Argos and Homebase, slipping despite solid first half results. Like-for-like sales at both their flagship stores increased. Total sales were mixed, however, with Argos growing 1.4% and Homebase down 2.8%. Clothing retailer Next also in the red despite a rise in first half profit of over 19%. The group also maintained its full year forecast. John Lewis also reported a rise in first half profits despite a 9% decline in operating earnings at its grocery chain Waitrose. Strength at its department stores helped to offset the slump, where sales ticked up 8.2%. Yannick, Naud, portfolio manager at Sturgeon Capital, is still with us, as is our UK business editor Helia. Yannick, I'll come to you first. Yes. Morrison shares up 4% initially on these results. Yes. That's despite a 51% fall in profits. Now just below that, the flat mark. What can you take from those results?
If you look at the result, I mean, the profit is down 51%. The like-for-like sales are down 7.4% when the analysts were predicting 6.7%. So it's a bad set of results. Nevertheless, Morrison is increasing by 5% the interim dividend. And I think that's the main thing, because right now the dividend yield is around 8%. Morrison has been very late in restructuring. They have been cutting price in May. Now they're 2 to 4% cheaper compared to the big four in average. They're very late in the loyalty card. I think they will introduce it by Christmas. They're late for internet. They're late for the convenience store, but they're going to that. So the dividend, in fact, is a way for you. You paid to look at the result, in fact.
But a dividend yield of 8% surely implies that investors feel, despite the interim, the small part of the dividend being maintained today, must expect that the main part of the dividend will be cut later in the year.
Well, it depends on what kind of free cash flow they can achieve. I think in terms of free cash flow, it is very possible that they will be able to maintain a dividend. You have to keep in mind, for example, they have a quite large real estate portfolio. They just started to sell and lease buyback some of their real estate portfolio. They can continue to do it, and it will be beneficial for the cash flows.
I mean, I think it shows you a very bleak picture actually today of UK retail, because yes, absolutely, you said it, Morrison, these look like dismal results, underlying profits down over a half, but actually it was ahead of, it's not just the dividend, it was ahead of what analysts had expected, so that's where you saw the slight pop. Again, remember that you've got numbers that came out from the ONS saying that people are spending less in their weekly spend at supermarkets for the first time since records began at the Office of National Statistics. So the price cuts that we're talking about are hurting the whole sector. And you know what's happening with Tesco's? They've had to parachute their new chief executive in very quickly. It looks bleak, even in Waitrose, which is one of these, has been these runaway success stories, you saw a decline. Now, they pointed to the fact that they've been investing in new store openings as the reason for this decline in profit. Overall, John Lewis does well, but it doesn't look rosy for the whole sector, and you're just buying shareholders when you give them a dividend, aren't you?
Yes. I mean, the only winner is Lidl and Aldi, which are growing. The market share is growing, the offering is getting better, the quality of the product is getting better, and they're taking market share as record pace.
And the fact that those discounters, the cheap end of the market, are doing well, is that a bad sign for UK retail in general?
Well, I mean, the available income, the disposable income for a household is not going up because there's no wage inflation.
So cannibalization, basically.
So all in all, the only thing you can do as a retailer is try to squeeze your cost base, your capital ratio, in order to be more efficient. But the market, the pie is not growing at all.
Indeed. Well,
it's getting cheaper.
Yeah.
Yannick, thank you very much. Helia, also thank you. That was Yannick Naud, portfolio manager at Sturgeon Capital, and our UK business affairs editor, Helia Ebrahimi. Still to come.